Liquidity swing strategy and trading. The liquidity swing strategy is a trading method that aims to capitalize on fluctuations in market liquidity, specifically during periods of high and low liquidity. Liquidity, in this context, refers to the ability to buy or sell an asset without causing a significant impact on its price. Traders using this strategy often focus on identifying where liquidity is concentrated and where it thins out, to anticipate price movements and position themselves accordingly. In this strategy, traders focus on key price levels where liquidity pools, i.e., areas with high buying or selling interest, are formed. They aim to exploit the imbalance between supply and demand in these areas, which can lead to sharp price movements, swings. This often happens at points of support and resistance, where a significant amount of orders are typically clustered. By tracking where these pools of liquidity exist and how they shift, traders try to predict when a price is about to experience a swing, either up or down. Key components of liquidity swings. Strategy. 1. Liquidity pools. These are price zones where a large number of buy or sell orders accumulate. Traders identify these zones using volume profile analysis, order flow data, or simply historical price patterns. For instance, support zones are where buy orders cluster, providing a floor for the price. Resistance zones are where sell orders concentrate, capping price increases. 2. Price liquidity gaps. Liquidity is not evenly distributed across all price levels. Gaps occur when there is a thin order book between key levels. These gaps create opportunities for rapid price swings once liquidity in those areas is exhausted. Thank you for liking the video. Let's go to the most important strategy from which you can learn a lot. Third order book. Imbalance. In highly liquid markets, the order book, a list of buy and sell orders, tends to be balanced. However, when there is an imbalance, more buyers than sellers or vice versa, it can lead to sharp price movements. Traders look for these imbalances as indicators of potential liquidity swings. 4. Liquidity hunts. This refers to when large institutional traders' smart money intentionally move the market to target liquidity clusters. For example, they may trigger stop losses or take profits near support resistance to capture liquidity before moving the market in the opposite direction. Retail traders can get caught in these moves if they don't recognize the pattern. High volume areas. High volume areas are critical to the liquidity swing strategy because they show where the majority of orders are placed. In technical analysis, these zones often correspond to support and resistance levels, where price has a history of reacting due to an accumulation of orders. 1. Price consolidation zones. These are areas where price tends to move sideways within a defined range over a period of time. These zones are characterized by high trading volume as traders place many orders in anticipation of a breakout. Support levels. A support level is where the price tends to stop falling as there is sufficient demand to absorb selling pressure. High volume accumulates here because buyers are stepping in. Resistance levels. Resistance is where the price tends to stop rising as selling pressure overwhelms demand. These are areas of high volume where sellers place their orders to exit positions or short the market. 2. Key psychological levels. Round numbers or whole numbers, e.g. $50, $100, $10,000, often act as psychological support chart resistance levels where traders place orders in anticipation of a move. These levels usually see a spike in volume. 3. Previous highs and lows. Traders often use past price action to identify areas of high volume. Previous swing highs or lows act as pivot points where liquidity is likely to be concentrated. Thank you for watching the video so far. I hope you can make the most of it. Watch the video related to the strategy.